Okay, let's dive into this explainer and unpack something absolutely wild that's happening right now. Wall Street's hottest trade, the yen carry trade, is officially cracking. You know, when a strategy becomes the undisputed darling of the financial elite, it feels completely bulletproof. Well, right up until the foundation begins to fracture. So, we're going to map out exactly what this trade was, why literally every major player piled in, and how its sudden unwinding is threatening to completely reshape the broader financial landscape. So, think about this for a second. What actually happens when Wall Street's absolute favorite bet just goes wrong? I mean, in everyday finance, when one person makes a bad bet, it's just a personal loss, right? But when an entire ecosystem adopts the exact same highly leveraged strategy, oh man, that failure creates massive systemic ripple effects. We're talking about a terrifying domino effect where the failure of one universally adopted mechanism forces the frantic selling of other assets just to cover massive losses. The stakes here couldn't possibly be higher. All right, moving into section 1, anatomy of the hot trade. Let's strip away all that dense financial jargon and look at the underlying mechanics. At its absolute core, this hot trade relies on borrowing capital at a near zero cost, specifically in Japanese yen, to invest in assets yielding a much higher return, like US tech stocks. It's the classic arbitrage of stability. Actually, it's kind of like picking up pennies in front of a slow-moving steamroller. As long as the environment remains perfectly predictable and interest rates stay flat, you can just rake in the profits, especially when you use massive leverage. But, and this is a huge but, it completely relies on the dangerous assumption that current conditions will never, ever rapidly change. Now, the contrast in the market right now is just stark. On one side, you have your traditional safe investments, diversified, low leverage, built with a really sturdy foundation to weather sudden macroeconomic storms. On the other side, the hot carry trade. Sure, it offers incredibly attractive, rapid returns, but it demands sky-high leverage, absolute concentration, and constant high-wire execution. Essentially, one strategy accepts lower returns for absolute peace of mind, while the other literally demands sheer perfection just to stay afloat. Let's jump to section 2, why Wall Street piled in. We need to examine the massive role of institutional FOMO here. Over $500 billion. Let that sink in for a second. That represents the estimated peak scale of the hot trade before the cracks even began to show. We aren't just talking about some niche strategy utilized by a few fringe hedge funds. No, this bubble absorbed a historic, mind-bending amount of global liquidity. The sheer gravity of this capital accumulation was just groaning under its own weight right before the structural foundation finally started to give way. Nearly 85%. That is the overwhelming proportion of institutional market participants who were engaged in this specific, highly leveraged setup compared to alternative global macro strategies. Everyone crowded onto the exact same side of the boat. And you know what happens in financial markets. When everyone is positioned identically, liquidity completely vanishes the very second people decide they want off. There is literally no one left on the other side of the trade to buy what you are frantically trying to sell. Which brings us to section 3, where the cracks appeared. The exact moment the momentum abruptly stops. So the collapse didn't just happen all at once, out of nowhere. It triggered in 3 really distinct phases. First, there was a subtle but historic upward shift in Japanese borrowing costs as their central bank finally raised rates. Second, we saw a slight deviation in anticipated U.S. economic data that sparked fears of a broader slowdown. And then finally, phase 3. The sudden, terrifying realization that the exit doors were way, way too small for the hundreds of billions of dollars trying to leave all at once. The leverage that amplified the gains on the way up, it violently amplified the panic on the way down. There's a phrase that perfectly sums this up. The strategy worked flawlessly, right up until the exact moment it didn't. I mean, talk about whiplash. This really captures that sudden pivot from extreme confidence straight into abrupt defensive posturing. The smartest minds in the room realized, pretty much simultaneously, that the underlying assumptions of their absolute favorite trade, cheap borrowing and endless tech growth, were completely shattered. Let's bring this home in section 4, what this means for you, looking at the real-world impact. So why should the average person care? Well, when a massive trade like this unwinds, institutions face incredibly steep margin calls. That forces them to sell off other, fundamentally safe assets just to raise cash quickly. And that creates broad, aggressive market volatility that bleeds directly into standard 401ks and retirement accounts. Simultaneously, liquidity across the broader financial system begins to dry up, which spikes the cost of borrowing for everyone. Basically, this unwinding acts as a brutal stress test, impacting asset prices far, far beyond the original boundaries of the trade itself. This leaves us with the ultimate question. Will this crack lead to a major structural market shift, or is it just a brief reset? As Wall Street's hottest trade continues to unravel right in front of us, the answer to that is absolutely going to dictate market momentum for the foreseeable future. Are we witnessing the end of an era for this specific leverage maneuver, or is this just a temporary panic before the crowd finds the very next hot trade? We're definitely going to want to keep a close eye on the data as this fascinating situation develops.